So this is an explanation of example 3 that is referred to in your topic 3. So I've given the reference in your lecture notes. This is slide 33 actually. Slide 33 deals with, so there are some gaps like this because when I'm pasting pictures into the document file, sometimes the picture is too big, so it skips a bit of space and moves on to the next page. But anyway, you have all the relevant information. The theory is given here. Actually, this should have been screenshotted first and then the example. That's how it appears in the book, but anyway, this is second. So you'll see this is basically whatever they've said here. It's the same information that you have in example 3. The only difference is that in slide 33, in slide 33 they have actually put this information less any amount paid for the asset by the employee, which is common to both, is put it here, less any amount paid for the asset. So they have repeated that information, which is common to both the methods, that you have to deduct anything paid for the asset by the employee. And in the textbook, they have, let me use the actual textbook. If you go further up here, they have done it more in a more mathematically elegant way, which is that if a term is common, you take it outside the bracket, and they have done it in that way. So they have mentioned for both the methods that any amount paid for the asset by the employee has to be deducted, which is logical, which we are doing everywhere. If you remember in housing benefits also, if the employee is paying anything, then we have to deduct it. The only exception to this rule appears in the case of fuel benefit, where you have to remember the special rule that unless the employee pays for the full amount of fuel, he does not get any credit for anything he has paid. So if the employee pays partially for fuel, please remember, do not recognize that payment because he will still be levied the full fuel BIK, whether he pays partially or not. So remember that exception for fuel. But anyway, so coming back to this, you'll see actually this is quite easy to remember. It may seem complicated initially. It is somewhat similar, but on the opposite side to your, if you remember your, inventory valuation, when we do inventory valuation and accounting, one of the things we mention is the lower of cost or market, right? So if we say how should we value our inventory, which we always say that it should be valued at the lower of cost or market. So whatever is the carrying cost, take that, and the market price. So whatever is lower, use that. Now this is kind of similar, but on the other side, which is because now they're talking about you having to pay tax. So obviously they want you to pay more tax. So this is actually, if you think about it, what is the first one? This one here is actually mentioned second on slide number 33. It's actually mentioned second here, but in the textbook it's mentioned first here. A is actually mentioned second in the slide. So market value of the asset at the date of the transfer less any amount paid, which is the same here, like this one. Obviously less any amount paid is common to both these. So that's the first one. So this is actually the equivalent of market, right? The market value. And then what is the second one, the B? If you think about what B is the market value of the asset when first given to the employee, less the amounts that have already been charged, which is the 20% every year. Every year you charge 20% of the asset's market value. So this is a statutory valuation rule. So it's a statutory charge. So you can think of this number B is actually like a carrying book value, because initially you put it on the books at whatever the market value is at the time that they buy it. And then you have been steadily charging the 20% of the market value for on the date of the market value every year, okay? And so please note that the assets value is not treated on a declining balance basis, like you charge 20%, so next year you charge 20% on 80%, no. You keep on charging 20% on the 100%. So that's one feature of this. So anyway, so if you take that, this number B actually becomes kind of like a depreciated book value type of figure. So you can think of it as some kind of a legitimate cost number, which is there on the books. So book value, so like not really cost or market, but book value versus market value. And so you're actually required to take the higher of the market value or the book value. That's what this rule is. So if you understand it like this, it'll become easier to remember. And then any amount paid, that's like a general principle which you have to always apply, with the exception of the fuel BIK. So now that you understood the rule, let's go back to the example. So in the Friday class, maybe I was a little tired or whatever. I got a little confused by the way they have arranged the numbers, so I wasn't able to understand what was going on here. But actually, they have done it the right way. I had combined these three together, but actually you should not, because you have to go strictly year by year. So this guy gets the music system given to him at £800. So that's the market value at the date of the loan. So they buy the system and they lend it to the employee. Now he keeps it for about 2.5 years, and then he buys it for the employer for £100. And there is some important information here which I had also not highlighted initially while discussing it in the class, which is that on the day that the employee buys it from the employer, the market value is $240. So this information is obviously given to you to attract this rule, okay, which is the A in the textbook, the second one. The market value of the asset at the date of the transfer to the employee, when it's being given to the employee. So this is going to become relevant for that one. Okay, so calculate the taxable benefit for 3 years, these 3 tax years. Okay, so they have done it the correct way, which is the benefit for 24-25, which will turn out to be first 80, which is because it's always 20%. But because this one is in this year is for 6 months, so it's 20%. 800 is 6 by 12, which is 80, which is half of the previous 2 years. Now, plus there is a transfer happening in this year. The employee is buying it from the employer for £100, but the market value on that date is 240. So you've got 2 methods to calculate. First is let's think of it as the market value method, which is we use this 240. So we take the 240 minus whatever he has paid. The market value method, if you apply, the current market value is 240 minus he pays £100, so the amount of the charges here is 140. And then if you take the other method, which is kind of like the book value method, what is the book value? Well, it was initially put on the books at 800, and then what kind of charges have we levied? We put 160 in the first year, 20% of 800, another 160 in the second year, and in the third year we put, because it was half, we put 80 charge. So the total charges is, so this is the book value method. So how do you calculate the book value? What is the price of putting it on the books at the time that you put it on the books? And then whatever kind of it's like a conceptually like a depreciation, except that it's not writing down the actual carrying book value. So it's like a tax. You can think of it as a tax book that is being maintained. So it's not following the accounting principles strictly, but I'm trying to discuss it in connection with the accounting principles so it becomes easier for you to remember. So anyway, so you got this. So 160, 160, 80. So the carrying book value type of concept will be 800 minus the 160 minus the 160 minus the 80. So whatever was charged. Here we are using the second method in the textbook and the first method which is mentioned here. So it may seem like a lot of text, but actually just think of it as a book value kind of concept, and then you know how we would derive that. So 800 minus 160 minus 160 minus 80 minus 100, which is common in both cases here and here, because this is what the employee is paying. So this now comes out to be 300. And so remember, the rule is the greater of these two. The market value gives you 140, and the book value method gives you 300. So you have to take the 300. Okay. So this is the one that confused me in the class on Friday, which is I couldn't figure out why they have put the 380, because actually I had mentally put the 80 over here along with this. So, but they have done it the right way, because the charge for this year is actually 80 plus 380, because 80 plus 300, which gives you 380, because this 300 is happening in this transfer is happening in this year, so this 300 charge belongs to this year. Right, so once you take that, then you take this 320 and then 380, that gives you 700. That's the total tax on this. Okay, so this is one clear example. Make sure you master these examples, do a couple more of practice. And so this is definitely, if there's a question, there'll be a question on this kind of a complicated question. It will involve a transfer of the asset to the employee after he uses it for a few years on loan. So there'll be periodic charges like this initially, and then there's a transfer, so you have to calculate the total value using the two methods and taking the higher of the two numbers. And one more thing, remember, when it comes to housing, when they mention furniture or furnished, the house was furnished, whatever, the house was furnished for this amount, don't make the mistake of adding that furnishing amount. That is referring to furniture, and furniture is an asset on loan, right? So therefore you have to take if there's like a value that they give you, like the house was furnished for £7,000 or something like that, you have to take it as £7,000 worth of furniture being loaned to the employee, and then you have to put 20% of that. Don't add that 7,000 to the cost of the house. All right, I think that finishes this particular example. I had mentioned in the class that I would record a video on this, so this is the video for that.